Hello, everyone. It's Professor Reiko here, continuing on with our chapter on pensions. So this is our fifth video, and actually the fifth and sixth video pretty much go together. So the fifth video here today, this one is we're going to walk through the different types of gains and losses that we can see that will affect our pension worksheet. And then in video six, I'm actually going to take these numbers right here. So kind of if you're going back and watching six, kind of try to remember some of these numbers because that's what's going to show up in the worksheet. All right, so we have these all of our numbers here, and if you look through here, we have two new things. We have this expected earnings rate, and then we have this actual increase to the PBO. So we'll talk about how we're going to use those. Everything else we've dealt with, so I won't get into those. All right, so let's kind of go through our different gains and losses. All right, so anytime you see the entries D and H, it's talking about the rows on the worksheet, which will be in the next video. All right, so we talked about actuaries in the very first video and how they use a lot of assumptions and estimates to help companies determine what goes into a lot of their pension obligations and things like that. And we might have different adjustments and things like that from the actuaries that we have to consider. All right, so let's walk through those. All right, so the first thing that we need to do is we're going to determine the difference between the actual and expected return on the plan assets. Now remember, we've already done the actual return. All right, so we've talked about that, but now it's saying we also need to consider the expected return. So we're going to consider both of those and see how that factors in. One quick thing to point out here, a lot of your, like usually if you're looking at your homework, especially some of the early exercises that are a little bit easier, a lot of the problems will say actual and expected return are blank. All right, so what they're saying is there's not this asset gain or loss that we're about to go through. All right. So if you read here, actuaries ignored the actual return on plan assets because it fluctuates. I mean, think about the market changes, back in 2007, 2008, when, we had a big recession. And then even now, I'm actually recording this from home while everybody's dealing with coronavirus. So we've seen a lot of market fluctuations that can really impact the return on plan assets. All right, so actuaries will develop an expected rate of return to determine the funding for a company. Okay, so the expected rate, which is given up there in the given information, is going to be multiplied by the plan assets. It says or some calculated weighted asset, but we'll just use the plan assets for the beginning of the year. All right, so here's our calculation that we'll use. The expected return is the expected rate, which is given, times the beginning of the year, the plan assets, which will be given as well. All right, so pretty easy calculation there. FASB agrees with using the expected rate of return when determining pension expense because it has a smoothing effect. All right, so if the actual return is greater than the expected return, that's a good thing, right? That means we returned more than we expected, so we call that an asset gain. All right, if it is less than it, that's a bad thing, or return less, we'll call that an asset loss. Okay, so hopefully that makes sense to you. When we look over the top of the next page, so how do we handle these asset gains and losses? All right, just like we've done in all the prior ones, we've said what we're going to do on the worksheet with them. All right, so asset gains are credited to other comprehensive gain or loss. So this is a new column, and it's our last column that we're going to add into a pension worksheet. So remember, last video we saw the other comprehensive income, prior service costs, and now we have other comprehensive income for gain and losses. So it's going to be credited to the OCI gain or loss, and then it's going to increase pension expense. So we're going to debit pension expense. And then asset losses are the exact opposite. All right, so there's any number of ways, a lot of times when people are trying to figure out how to put it into a pension worksheet, for me, I've always just kind of remembered gains or credits and losses or debits. And so for me, in the gain or loss column, that's easier to put a gain as a credit and loss as a debit. So that's typically how I think through it. All right, so let's calculate the asset gain or loss. All right, so remember, we said it's going to be the beginning plan assets, the fair value of plan assets, times the expected rate. All right, so the beginning plan assets. Now remember, this number, because we're using the same company over and over again through all these videos. So this is the ending balance of the plan assets in video 4. All right, so that's where this number comes from because it's not in the given information on the previous page. The expected rate is given 10%, so we'll just move the decimal point, 19,870. Okay. Now remember, that's the expected return, but we kind of want to capture the difference between those. All right. So the actual return is given. Remember, that will come from the trustee. They'll tell us that, how much the plan actually returned, versus the expected return, which is 19,870. All right, so my difference here is 4,130. Now, if we look at this, we returned more. Our actual return is greater, so that's a good thing. So we're going to call that an asset gain. Okay, so this is the number right here that's going to end up in our pension worksheet for the asset gain. So we'll see that in a second. And it says right here, as a result of this adjustment, the expected return is the amount actually used to compute pension expense, thus achieving a smoothing of pension expense over time. Well, and what that means is, let's think about this. We are going to record, so if an asset gain up here is going to be a debit to pension expense, the actual return, remember, is a credit to pension expense. So when we net the 24,000 with the 4130 in two different rows, the end result will be this number. Okay, so I'll point that out again when we do the worksheet. We just basically are showing the expected return, but we're showing it through two different numbers. All right, so the actual changes, the second type is on the liability side, and I call these liability gains and losses. So it deals with the PBO. So asset gains or losses deal with return from the plan assets, the asset side of things. Liability gains and losses deal with the obligation, the PBO. All right, so any changes in actuarial assumptions can affect the PBO, all right, which is our future obligation. All right, if an actual change causes the PBO to be increased, that means we are going to call that a liability loss. So obviously, the easy way to remember that is if I'm increasing the PBO, it's going to be a credit to the PBO. And then once again, if I'm calling it a loss, it's a debit in the gain or loss column, right? So we have two possible things going into the gain or loss column here. And then if it's decreased, it's the exact opposite. All right, so notice here, this one does not affect pension expense. All right, so it's included in OCI. No adjustment is made to pension expense in the current period. So we consider gains and losses a component of pension expense. And if you look back to the second video, we said that the liability gain or loss will affect it in future years. Well, how does it affect it in future years? Well, changes to the PBO will impact interest costs in future years, and then the gain or loss, and this is important, may have to be amortized, and that's going to be video. Let's see, this is 5, 6. So video 7 will do with amortization of that. Okay, so we'll hit that. Come back to that in a second, or in the future video. All right, so we have two possible pension. We have two possible gains or losses: the asset gain or loss and the liability gain or loss. All right, so what we're going to do, so kind of remember the numbers from this video, and what we're going to do next is go straight into video 6. Which is going to be the worksheet with this given information. So these two videos pretty much go together. So make sure you just kind of roll right into video 6 and kind of see how it all plays out on the worksheet. All right, so hopefully that's helping. Make sure you tune into the next one, and we'll keep going with the worksheet for this example right here. I'll see you next time.